this is Dr. T. Varalakshmi discussing you about average rate of return or accounting rate of return and profitability indexes related problems and solutions as a part of capital budgeting in business economics and financial analysis. ARR, accounting rate of return or average rate of return, a non-discounted cash flow method using in the capital budgeting technique is called as the average rate of return. In the capital budgeting techniques, especially when the company wants to invest into the projects or that to the long-term projects, the decision making, some strategies they will use or some techniques they will use. In these techniques, two methods are all there: discounted cash flow methods and the non-discounted cash flow methods. If the time value of the money takes into the considerations, they will be called as the discounted cash flow methods. If the time value of the money not takes into the consideration, that will be called as non-discounted cash flow methods. In this non-discounted cash flow methods, time period to get back the investments is called as payback period. And the on an average getting of the returns is called as the average rate of returns. Simple and very simple mathematical expression it is. For example, if a person is invested 1 lakh rupees and he is getting 10,000 rupees as the returns. So on an average 10% of the returns he is going to be get. That is only the one. And that means 10,000 is the cash inflows divided by average investments is 1 lakh into 100. 4 zeros gets cancelled. 101, that is 10%. That is on an average 10% of the returns are all gaining by the organization. So like this, the company will calculate the average rate of return based on the accounting information provided. So here the investments values, book values are all taking into the considerations. That's why it is called as accounting rate of return. So here the formulas are also very easy to remember. Average annual profits divided by average investments, whereas the average annual profits is equals to total profits over the investments divided by the number of years. And average investments value will be calculated with the help of book value at the year 1 plus book value at the end of the useful life divided by 2. So average values they will take into the consideration. So let us see this as examples with the problem 1. XYZ company is looking to invest into new machinery to replace its current malfunctioning one. The new machine will cost 4,20,000, would increase annual rupees by 2 lakhs and annual expenses by 50,000, and the machinery is estimated to have a useful life of 12 years and 0 salvage value. Now for this one, by using this ARR, we have to calculate this, whether the organization can purchase this, invest into that machinery or not. Step 1 is calculation of average annual profits. That is the cash inflows. So year 1 to 12, every year they are going to be get 2 lakhs rupees means 12 years they are going to be for that 12 years they are going to be get 2 lakhs means 24 lakhs rupees of returns they are going to be get back. Out of this one, annually they are expending of 50,000 rupees. Every year they are spending 50,000 rupees means for the 12 years the life of that machinery they will spend 6 lakhs rupees. And the depreciation is 4,20,000. So the total profits with that machinery is 13 lakhs 80,000. 13 lakhs 80,000. And average annual profits are all for the total 12 years it is means by 12 means if we on an average they are going to be get 1,15,000 rupees of the profits every year. And step 2 is calculation of average investment. First year 4,20,000, salvage value is 0 divided by 2 means the average of that particular machinery investments is 2,10,000. If we apply them in the IRR formula, that is average annual profits divided by average investments, that is 54.76%. Therefore, that means that every dollar invested, the investments will be a return of 54.76 which means for 1 rupee, nearly they are going to be get 54 paisa as the returns. The same one, problem 2, if we see XYZ company is considering to invest into the project that requires an initial investments of 1 lakh for some machinery, and there will be a net inflows of 20,000 for the first 2 years, 10,000 in the in 2 years, the for the 10,000 in 2 years, in years 3 and 4, and 30,000 in years 5. Finally, the machine has a salvage value of 25,000. Here, the cash inflows were not common. They are all changing. For the first and second years, they are going to be get 20,000 means annually 20,000 means for the 2 years 40,000 of the income they are getting, and third and fourth year 10,000 each year means 20,000 rupees of the amount they are going to be get, and the fifth year 30,000 means so they are going to be get totally 90,000. So out of this one, we will less the depreciation amount. Then depreciation amount will be 1 lakh. Out of this 1 lakh, 25,000 worth of the salvage value they are going to be get. So that is 75,000. So 75,000 is the depreciation on that particular machinery, means that the total profit is 15,000 rupees. And the average annual profit is 15,000 divided by 5, that is 3,000. 15,000 for 5 years, they are going to be get back that amount. So that's why it is 3,000. And average investments is 1 lakh minus 25,000 salvage value is there. And 2 by divided by 2 means that is 7,500. And by using the formula of ARR, 3,000 divided by 37,500, that is 8%. So here, the depreciation means actually they have purchased the machinery for 1 lakh. And after selling of that machinery, they are going to be get back 25,000 rupees of the funds, means the remaining amount, depreciation amount with that machinery is 75,000. Total profits gaining with that with that machinery is 90,000. But the machinery cost, if we less 75,000, the remaining is 15,000 is the profit. 15,000 is the profit for how many years means 5 years. 1, 2, 3, 4, 5 years. So on an average for every year, they are going to be get a return of 3,000 rupees. So that is only we have taken into the consideration. So next one, problem 3. Let us take the example of real estate investments that is likely to generate return of 25,000 in the year 1, 30,000 in the year 2, 35,000 in the year 3, and the initial investments of 3,50,000 with a salvage value of 50,000. And estimated life is 3 years. Do the calculation of the average rate of return investments on the given information is possible or not, and what is the average rate of return we have to calculate. And they have given to us is annual net earnings roll. For the first year it is 25,000, second year 30,000, third year 35,000. Life is 3 years. Initial investment is 3,50,000 and the salvage value is 50,000. So this is a summary of the given data provided for us. If we see this solution, average annual returns is equals to sum of the earnings at year 1, 2, 3, that is 30,000, and divided by the number of years, it will be 30,000 average returns. Average returns value will be average annual returns is 30,000. And average returns value divided by 35,000, that is ARR value if we wants to calculate. Initial investments is 3,50,000 minus salvage value of 50,000 into 100. That is average rate of return is 10%. So the average rate of return for this particular organizational investment is 10%. Simple. So they are investing 3,50,000. Out of this one, they are going to get back at the end of the year 50 means they have invested 3 lakhs. Every year they are going to get 30,000 of the average returns, means their average rate of return is 10%. So like this, we can calculate this average rate of return for the given problem. The same thing if we see for this next one, an initial investments of 1,30,000 is expected to generate annual cash inflow of 32,000 for 6 years. Depreciation is allowed on straight line basis, and it is estimated that the project will generate a scrap value of 10,500 at the end of the 6th year. Calculate its accounting rate of return assuming that there is no other expenses on the project. Annual depreciation value, if we want to calculate, initial investments minus scrap value divided by useful life in years. So initially they are investing 1,30,000 with a scrap value of 10,500. Divided by 6 years means the depreciation on that machinery, the reduction in that machinery value is 19,917. And average profits of the organization is 32,000 minus this depreciation. That is, every year they are going to get a return of 32,000. Out of this one, depreciation if we less, the average accounting income is 12,083. So, accounting rate of return is equals to average investments of average profits of 12,083 divided by average investments 1,30,000. That is 9.3% is the average rate of return. The same way, if we take this fifth problem, that is comparison between the two machineries. A company is considered to purchase a machinery of machine A and B available with 80,000 each. So every machinery, both the machinery A cost is 80,000 and the B cost is 80,000. Earnings after taxations are all provided for us. For this machinery A, 24,000, 32,000, 40,000, 24,000, 16,000 for the 5 years respectively. Whereas for the machinery B, 8,000, 24,000, 32,000, 48,000, 32,000 for the machinery B. So here we need to calculate the average rate of return. The rate of return on the investment method, if we see, cash flows for this machinery is total 1,36,000. For the machinery B is 1,44,000. So that average annual cash flows 1,36,000 divided by 5, it will be 27,200 rupees. And for this machinery B, 28,800 rupees. And the depreciation is 80,000 they have purchased for the every year. Straight line means 5 years the life of the machinery means depreciation is 16,000. So the net savings are all 27,200 minus 16,000 will give 11,200. For this one, 12,800 for this machinery B. And average investments are also 80,000 is the investment of that machinery divided by 2 means 40,000, and this one is also 40,000. And the return on investments or the average rate of return, if we have calculated 11,200 divided by 40,000, that is 28%. And for the machinery B, 12,800 divided by 40,000, that is 32%. From among these two, machinery B is having more ARR than the machinery A. So it is suggestible for the company to purchase B machinery than the machinery A. So that is about the various data calculations for this average rate of return with the given data. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.